Okay, if we move on to question number 4. So let's see what is required for question number 4. So the first thing we do is we scroll right to the bottom. Now you can see this is a very long question. So the first thing you have to do is you have to calculate the tax liability. Okay, so read what have they asked you to calculate. Your tax liability is your normal tax less any provisional tax payments. And it is for the year ended 30 June 2020, and they tell you provisional tax amount are 700,000, 1,500 Rand. And then they tell you additional information. As soon as you see additional information, you know you need to do something with it. We do not give you information just for the hell of it. Specific instructions are there to guide you, to help you. So they said they elected to claim the Section 11.0 allowance. So that is if you've got a scrapping allowance, and make use of the Section 13 building recoupment set off. Okay, so that says if I've got a recoupment on a building that I've sold to purchase a new building, then that recoupment can be written off against the cost of the new building, and then we write off the remaining amount for wear and tear or capital allowances. If you see this provisional tax payment amount there, what I would suggest is you start off with the framework and you go put in that amount straight in the beginning so that you get that mark and you don't forget about it. So before we go on, let me quickly show you what the framework is supposed to look like. So this is going to be your starting point. Okay, I'm just going to make it a little bit smaller. Okay, so what you do is you add a description, you add a column. You can either do a column for the calculation or you can do the calculations at the bottom. That is all up to you. And then because they will incorporate your capital gains tax in this, make two columns, one for your capital gains amount so that you can add that all together to get to the aggregated capital gains, and then your income tax column. Okay, so that is where you will show your gross income, exempt income, any deductions, as well as your taxable capital gain calculation. And then if you've still got a donation, the donation after that deduction to get to your taxable income. So you would go do the framework. Now, they haven't done it in that format, but normally I would start with gross income. I would do exempt income. I would leave about 10 lines for gross income, about 10 lines for exempt income. When you get to the deductions, generally leave about 20 to 30 lines because that's normally where the bulk of the information is. And then for your capital gains, based on the information, I would leave about another 10 to 15 lines to get to your taxable income amount. Okay. Now, because we know that we have to work out the tax liability, so in your test, maybe leave 2 pages for your taxable income calc. Then you go write down this calculation, your normal tax, which will be based on your taxable income amount. Then you've got your provisional tax and your tax liability. Now, because they've put the provisional tax amount there randomly at the instruction, I would suggest go write the normal tax, provisional tax, tax liability, go put in that amount, and you've already scored 1 mark before you even go through the rest of the information. The aim for your exam is to try and get the easy marks first. There are things that you can literally just enter in and get amounts for it to make sure that you get to that 50 as quickly as possible. Yes? Is it a must to? Okay, so I've got a question here in the class. Do you have to do it based on the framework? Okay, if they do not state it needs to be in terms of the framework, you can enter it as you want by showing the income exemptions, just group them all together. If they tell you the framework, then you need to go listed gross income, exempt income, then you have to apply it. Okay. But in this scenario, because the question didn't specifically state it, you can follow it based on the information provided. Okay, to make it easier for you. Okay. So then you just go enter that amount. You've already got a mark before you even started with the rest of the question. Okay, so I'm just going to share the PDF again so we can go through the rest of the question. Okay, number two, they ask you to, number two, they said you're not willing to reduce the tax bill if it means doing something unethical. So you have to write a memo to Mr. Jacobs advising what he could do for MoVCC to be regarded as a small business corporation. So as soon as you see a small business corporation, it means you will have to apply the requirements. Now you can see they've given you additional information as well as the mark allocation. So firstly, for 1 mark, you have to say what he should do to qualify as a small business corporation. So that means one of the requirements would not have been met. So there's some form of action he needs to do. And then the other requirements that need to be met. So now you list the other requirements. And that is 9 marks. But what they do to help you out is just below that, they tell you you have to state at least 4 requirements. So a minimum of 4 requirements and apply it to the facts. So you state a requirement, you apply to whatever is in the question. So that is already 8 marks just by doing that. Okay, and then the last thing that you have to show is the benefits and the allowances that are granted if they choose this option. So now we are showing if they can register as a small business corporation, what benefit will it have? So by reading the required, you already know, okay, fine, I have to do the income tax calculation, but I also have to look out for information to help me answer the small business corporation elements. Okay, so let's go through the question and see what have they given to us. Okay, so the question starts, you see it's 60 marks, so this question would take you an hour to do. Okay, you are a qualified chartered accountant, and after completing your articles, you are offered a job at MoVCC. The CC manufactures electronic equipment. As soon as you see manufactures electronic equipment, the following section 12C, needs to pop into your head. Okay, for your capital allowances. But because we also know that we have to eventually discuss small business corporations, for a small business corporation, the equivalent is section 12E. Okay. Now, section 12C says if it is new, I apply 40% in year 1 and then 20% for the next 3 years. Okay. If it is used, we will apply 20% for 5 years. Okay, so that's what section 12C tells me. Whereas if it's a SBC, it says it is 100% if it's a manufacturing asset. And 50%, 30%, 20% for your other assets. Okay, but remember that is all your movable assets. That is what this applies to. It does not apply to your buildings. Okay, next information they tell you, the CC has 3 members. Okay, so we've got a CC, they've got 3 members. It's Mr. Jacobs, Mr. Rhodes, and Mr. Abenaki. Okay, so we know that The members are all natural persons, which is a requirement for a SPC. Okay, who has invested a substantial amount into the business. None of the members hold any interest in other companies or closed corporations, but Mr. Jacob owns 40% shares in ABC Pty Limited. The other 60% is owned by his father. Okay, now if you read the information, they talk about his father-in-law is a member, so it's only Mr. Jacobs that has interest in another company. Now for a SPC, your members are not allowed to have shares in other companies. Okay, so just based on that fact, you already know what the thing is he needs to change for that 1 mark and part of question 4.2. Just see, okay, no, it's not a question. Okay, so that is how you have to read it. They tell you he is currently not regarded as a small business corporation. So currently we apply the normal 28%. Okay, and they've got a 30 June year end and they are registered for VAT. Now, if they tell you they are registered for VAT, if you see any amounts including VAT, you have to exclude it. If they do not talk about VAT at all in the question or do not mention they are registered, do not include that amounts are inclusive of VAT, do not say something is including or excluding VAT, you ignore it. You do not touch VAT in that question if it's an income tax question. Only where they specifically note we are registered for VAT and they specifically talk about VAT as part of the amounts. Okay, then they tell you all amounts exclude VAT except where otherwise stated. So if an amount is exclusive of VAT, we apply it as is. If it's inclusive of VAT, we remove the VAT first before including it in our income tax calculation. Okay, so the first thing is our sales amount is 8,910,000. 90% of this was cash and the rest was credit. Now that additional information is irrelevant because we are taxed on the earlier of invoice or payment date. So if it's cash, we receive the payment first. If it's credit, it's invoice date. So that information is just to try and confuse you. Okay, and see if you're going to apply the 90% when including it. Then we've got local dividends of 82,000. Now remember the local dividends is also exempt, but you have to show it in the gross income first and then show the exemption afterwards. Okay, so you show me the in, you show me the out, you get 2 marks for this. Do not show me a 0. You need to show the in and the out. Okay, then machine Belvedere, this is where we are going to apply your section 12C information now. Was purchased second hand. Okay, so it's second hand, so we are going to apply the 20%. Okay, because it's second hand, it's used. And it is including VAT, so we have to remove the VAT amount. Okay, so you'll see it was purchased in 2019, May 2019. Because our year end is 30 June 2020, our tax period is, let me just do the tax period for you guys, would be 1 July 2019 to 30 June 2020. So you will see that that machine was already purchased in the prior year. So this would be the second year we are deducting this. Now, because it's 20%, it would be exactly the same amount. Remember, for this section number 12C, we do not apportion it. So it doesn't matter how long I've used that asset during a period. I apply the full 20%, irrespective whether it's for a day or for a year. Okay. So we are going to apply the 20%. Now, if we look at the chestnut machine on the other hand, it is a new machine. Okay, so here we are going to apply the 40% as opposed to the 20% for a used one. Okay, and I said it doesn't matter how long you've got it, so even though we've only used it for a month, we apply the 40% in full. Then we've got a microwave was purchased for 5,700, including VAT for staff canteen. Now here we're testing, do you know the VAT principles? Now remember, because it's for staff canteen, your input VAT would have been denied. That means we would be able to apply Section 11E to the full 5,700. Okay, so this is Section 11E, which is your wear and tear allowance. Now there is a specific rule that says if the amount is less than 7,000, I can deduct the full amount in that year, but I have to leave R1 for the tax value. So that means I can deduct the full amount, okay, and we leave R1. That's just the practical rule that we apply. So we are going to deduct not 5,700, but 5,699 Rand. Okay, so that's how they practically apply it in practice, the specific rule. And they actually give you a mark for taking R1 off when deducting this. Okay, so this is in your workbooks. Let me quickly see if I wrote the page number. It's on page 83 in your workbooks. So just make sure that you know of this exception. Then the next thing is we've bought a conference phone system for each of their 3 boardrooms on the 1st of August. Okay, so this is a phone system. 1st of August, this would also be 11E. Now 11E, we have to apportion. Okay, so we did not have it for the full year. So 1st of August, if you go count the months, is 11 months we've used this. So we have to go apportion this. They give us the total cost. So you do not have to multiply it with 3 because they've already given you the total and not the price per phone system. Then the next one is your research and development. So research was undertaken to develop a cell phone that could print pictures straight from the device. Now remember, for research and development expenses, if it is approved by the Minister of Science and Technology, which it was, and it is incurred in South Africa, we can deduct 150%, but only expenses. Where it is a capital asset, we apply the 50-30-20% rule, and then there are certain expenses that are not allowed. So our salaries, we will apply the 150%. However, the research equipment, because it's a capital asset, we would apply the 50% capital allowance for year 1. Okay, so this is the first year, so we would apply 50% from the 50-30-20% rule. Then the testing and administrative cost. This one is not allowed in terms of Section 11B, so your research and development, but we can still deduct it in terms of Section 11A, which is our general deduction. So we will deduct this at 100% and not at 150. Okay. So just remember, any testing or administrative costs for research is excluded from the 150, and then you apply your general deduction rule. Then the next thing they tell you, after numerous complaints from the inventory manager last year, it was seen that the stock management system was slow and outdated. In 2019, in the previous year, a computer was taken from stock, loaded with the proper software, and given to the inventory manager. The cost of the computer was $12,500. Then in the current year, it was seen the computer was still not adequate to meet the requirements for the stock manager, and the computer was sold. Okay, so we sold the computer in the current year. Now, because it was taken from stock and given to the manager, this would be a special inclusion for items that are similar to trading stock. So this is a special inclusion that you included into your gross income as if it was trading stock that I've sold, because it would no longer form part of your trading stock. It would have been moved to your capital assets. But because of the fact that it was trading stock, moved to capital assets, and then disposed of later, it is specifically included, similar as trading stock. Okay, so this was a specific inclusion. Then we've got our manufacturing cost. Now this excludes the previous one. So if it was included, you would have to remove it from this information because you would have already dealt with it separately. Okay, now what is important with your manufacturing cost? You see they give you the cost and the market value. You only apply the lower of the cost and the market value for your opening and closing stock. You do not apply it for any purchases. Okay. I'm just going to repeat that. You apply the lower of the cost and the market value, but only for your opening and closing stock, not for any purchases or stuff that you use during the year. So this material one, you would use the actual cost amount as opposed to the market value. Okay, so this is how they're trying to confuse you. And we are allowed to deduct all of it. We deduct the opening and we add back the closing. So this one we would deduct, and this we would add back. If you had to do the framework, the closing inventory would form part of your gross income. Then we tell you a cell phone with a cost of $11,900 and a market value of $13,220 was taken by the marketing director for personal use. Okay, so as soon as it is for personal use, it is a deemed donation. Because it's not to a PBO, we recoup that amount at the market value. Okay. So it's deemed a donation and we recoup it at market value. Okay, but only because of the fact that we sell cell phones. That is what our business is. Okay, then the next thing is the data's value of $28,500 was written off. Okay, but included in that amount is an amount of $1,500, which is a staff loan. Now remember, for an amount to be written off as bad debt, to get the deduction, you had to previously have included that amount in your gross income. Now a staff loan is capital in nature, so it would never have been included in your gross income, so you will not be allowed to get a deduction for the $1,500 because of that reason. Okay, but the rest of it would be deductible. So in this scenario, you will have to show both amounts for me. Show the trade debtors, which is deductible, and show the staff loan, which is not deductible. Then our salaries and wages. Now, salaries and wages, you deduct as is. If you see any contributions to a provident fund, a medical aid fund, you deduct that amount as well. Okay. So any amount you pay for your staff can be deducted. The exception is our annuities, but that is where they retire due to ill health, old age, or they were unfit. Okay. But if you see Provident or Medical Aid Fund, deduct it. Don't wonder about it, just include it. Then they tell you due to cash constraint, the VAT was paid late and the company incurred a late payment penalty. Now we know that any penalties or interest is prohibited in terms of section 23. Okay, so we cannot deduct it, but you have to show that it is prohibited. Then we have a donation of 45,000. This was made to a PBO, and they tell you we've got the relevant documentation. So this means our section 18A deduction at the end will need to be calculated. It is limited to 10% of that subtotal or the lower of the donation amount. Now, based on the value so far, it will probably be the donation amount because that subtotal will be greater than 10% of that, just based on what I've seen so far. Then you've got other general costs, which you can deduct, which is the 322,765. Then, Then we've got our legal expenses. Now, when you see legal expenses, be careful to see what it was for, because some of it might potentially be capital in nature. If it is something that relates to your business and generating revenue or protecting the revenue in your business, it is deductible. If it is anything that relates to a capital type asset, so it's transfer documents or it is a sales agreement or lease agreement contract, so the paperwork for company type stuff, then it would generally be more capital in nature if it relates to buildings and all of that. So let's quickly see what do they give you. We've got our transfer documents of a factory purchase. So this is relating to the factory we're buying, which is capital in nature. So the factory is capital, so this is also capital in nature. The next one is collection of outstanding debtors. Outstanding debtors is part of our business, so this is revenue in nature. So that means I can deduct the 6,000, but the 4,500 would be capital, so I would have to show it as a 0. Okay, then the company owned a factory. Okay, we owned a factory. The factory no longer meets the capacity of the increased demand, so we decided to sell the factory and buy a bigger factory or we purchase as a replacement. Okay, the fact that they tell you they are replacing it with a bigger one, this is where your section 13 recruitment referral comes in. So I'm going to deduct that recruitment from the cost, and then the balance will be written off for our capital allowances. Okay, so this is an exception to the rule, and because of the fact that they've stated in the additional information or in the note that they will apply this, this is where it is applicable. This is where the information is. Okay, so they tell you the original factory purchase on the 21st of June 2011 cost 1.8 million including VAT, so we have to remove that firstly, and then it was sold for 1.8 million and the proceeds were put towards the new factory, and the new factory was 2.2 million. Okay, so in this question, we will have our section 13 allowance, we will have the recruitment, and then we will have an allowance for the new building as well. So, and potentially a capital gain. Okay, so there's 4 things that you could potentially get out of just that one bullet point. And then they give you the binding rules. So this is your write-off periods. We will give it to you. Now you can see the telephone equipment is 5 years. Kitchen appliances are 6 years. Now here we are seeing if you know about the fact that anything under 7,000 can be written off in full. And then the computers, the 3 years, that is where we have the recoupments or where it was sold as trading stock. So those you don't write off. Okay, so some of the information, we call it a little red herring. It is there to throw you off when you do the calculations. Okay, then the last paragraph just talks about the fact that they're under a lot of pressure to try and improve the cash, and they want you to do whatever you need to make the tax bill less than it should be by inflating deductions or reducing the income, and they will pay you, take you on holiday if you do it. This type of information, they did not ask it, but this would generally link in with the code of conduct if they were to ask it. Okay, so in some of the past papers, they do ask you to explain the impact on the code of conduct, which actually comes from your other subjects. So just make sure that you know from a code of conduct point of view what could potentially be the impact. So it's generally your self-interest or familiarity threats or those type of things you would have to list here. Okay, so I think let's take a 10-minute break and then we're going to do the physical calculation. So if you guys can be back at 20 past 10, then we'll continue with the calculation based on what we've discussed now.